you can't change systematic risk. And that's something that natural capital is provocative to. Because if, as a society, if as economies, we have consumed too much of nature, then we are actually acting upon that systematic risk.
Leandros and Darran, welcome to the Rebalancers podcast. It's great to have you both on the show. Could you introduce yourselves to our guests?
Sure. Firstly, well, it's great to be here. Thanks for inviting us. My name is Darran Ward. I'm Head of Alternatives at West Yorkshire Pension Fund. I've been there since 2008, originally as an equity manager, and in more recent times I've run a listed alternatives portfolio and now run an alternatives portfolio across public and private markets with some sustainability beliefs.
Thank you. Leandros.
Thanks for inviting us today, Walid. Leandros Kalisperas, Chief Investment Officer of West Yorkshire Pension Fund. West Yorkshire Pension Fund is a 20 billion fund, operates within a very large 400 billion funded public sector pension plan for the UK. We're the third largest within that system. And what distinguishes us within the system is that we are a primarily in-house managed scheme. So we invest directly in equities, in bonds, in private markets.
Thank you. And so you mentioned your local government pension scheme. And for our audience, which are not UK based, could you tell us a little bit about that, please?
Yeah. Pension fund systems, across the globe are differentiatingly set up. Within the UK, we have both funded and unfunded public sector schemes. The LGPS, or the Local Authority Pension schemes, are a funded pension plan. That's the first thing to note. What that means is that there are real investments that are backing, the employer and employee contributions and the liabilities of those schemes. The 400 billion that I touched upon is invested across 86 underlying local authority pension funds in England and Wales. West Yorkshire, as I mentioned, is the third largest of those. And because we invest in-house, we have a large investment team set up in Bradford, which is the administering authority for West Yorkshire.
So for our audience, for simplicity's sake, I'm going to use WYPF to represent West Yorkshire Pension Fund with your permission. So I'm curious to find out, because why WYPF is a trailblazer, and how did its governance and flexibility enable natural capital investment? But before you answer that question, I'd love to get your views, both of you, on what is natural capital and how is this important?
So I think of natural capital as a key infrastructure that supports economic growth. There's academic literature that says that nature supports, half of GDP around the world, and one can believe that. And so natural capital is simply a way of expressing that infrastructure to me. And that therefore it's important because we're investors linked to economic growth, and therefore we need to think about where we can invest in natural capital as part of our financial investments. Darran?
Yeah, I agree. I mean, it's the ecosystems that we all rely upon. And you're correct, it's 55% of global GDP is moderately or significantly dependent on nature. It's important to us from both a risk and a return opportunity. A risk in terms of some 85% of our existing companies are highly dependent on nature and face nature risk. But we also see it as an opportunity to invest in, and a highly underpriced asset as things stand.
And that puts you, in that kind of mindset, puts you ahead of quite a lot of the other people. And I was coming back to my original question, which is, what is it about your governance and flexibility that enables you to look at natural capital as an investable asset class? Can you shed some light on that?
Universal asset owners are again set up differently, but it's about governance first and foremost. We're set up in a way that we are a fiduciary manager on behalf of our 300,000 plus members. What that means is that, at a high level, I as Chief Investment Officer am proposing the strategic asset allocation to our investment committee, and then I'm charged with implementing on that asset allocation. What that means is that there's an intimacy and a connection and a connectivity between the strategic asset allocation and the implementation. So that creates in and of itself a flexibility that is sometimes not there when you are splitting up the investment strategy with the implementation. That's point one. But you then have to actually use that flexibility. And so when I came in to WYPF, I wanted to make sure that if we were going to be progressive with respect to things like natural capital, we had to actually put in place certain things to use that flexibility. So, pension funds tend to have a triennial valuation. Every 3 years, they look at their liabilities, they reset the strategic asset allocation, which then creates the set of asset classes that it will invest in. And when we were doing this exercise last year, I was very keen to propose to our investment committee a 5% allocation, not simply to natural capital, but to things that were connected with our investment beliefs. And then I set up a new mandate and program, which Darran runs, which then allows the flexibility for Darran within that new mandate to then think about specific things, which obviously Rebalance Earth was one of the key initial ideas.
And let's talk about those investment beliefs, because obviously that played an important role. Can you perhaps tell me a little bit about them?
So investment beliefs in general terms are an important part of the client, which in this case is effectively the 300,000 members.
And what kind of members are these? If you could shed some light on examples.
These are people doing critical local jobs within our communities. The average pension plan, just to give you a sense, is £5,000-6,000 in retirement. So these are not affluent members that we have, but the pension is a critical importance to their retirement. And then when you're setting up the investment beliefs, you're obviously having to think about what members and employers are interested in. So the exercise we did a little over a year ago, we brought in someone, Pensions for Purpose, which is an organization, it says it in the name, that looked to coordinate how we would reset our investment beliefs. And the way we did it is we looked at the 17 UN Sustainable Development Goals, and amongst our investment committee and members, we gave thought to what the priorities were. And we came up with 5 key UN Sustainable Development Goals, which we then brought into 3 common themes. And within that, the Rebalance Earth, when it eventually came to pass, hit all 3 of those beliefs.
And from your perspective, Darran, do you want to shed some light, in terms of from your role, those investment beliefs or the UN SDGs, how did they play an important part?
So as a reminder, those UN SDG beliefs that we prioritized them because they're most appropriate to our pension fund. We felt they were most investable, and therefore it's where we could have the most impact. And those were in clean and affordable energy, climate action, sustainable cities and communities, innovation, industry, and infrastructure, and economic growth, driving decent jobs. So there's 5 UN SDG beliefs, but there's sort of 3 themes: sort of an environmental one, a social one, and an economic one. And we've grouped them as climate solutions, sustainable cities, and innovation driving decent growth. And then, what sort of investments are we looking at? We've already got existing investments in energy transition, in affordable and clean energy. So we've got a direct investment with GLIL, which we're very proud of. They've got investments in wind and solar. We've also got investments within alternatives in the listed space, where we've got wind, solar, hydro, and we'll be doing more as things progress. We're also looking at natural capital as an example of climate action, climate and nature solution. We're looking at sustainable cities. We're thinking about affordable housing. We're thinking about transportation, but we're also thinking about environmental solutions such as nature-based solutions that provide those resilient cities, those resilient communities, which are so essential for the economy, for the companies, and for the portfolio companies that we invest in. And then we continue to look at the infrastructure, and we continue to believe that nature has a role to play as business critical infrastructure. It's highly innovative. It's billion-year-old technology in terms of photosynthesis, but the developments in technology are really leveraging where we can have impact and how we can monitor it and how we can report it. The developments in artificial intelligence. We talked on the journey here about data mirroring, drones getting to inaccessible areas. This is all fantastic stuff in terms of how we can really pinpoint those nature-based solutions, how we can monitor them, how we can test them, and how we can report them. And then the final piece is economic growth, driving decent jobs. And where nature comes in here is that it can provide those resilient economies, decent jobs in rural communities that have perhaps previously been deprived. So across the piece, nature can apply to everything. And actually, when you look at those 17 UN SDG beliefs, I think you could apply nature-based investments across almost every one of them, whichever ones we chose, obviously life on land, life underwater, but also poverty and hunger. So I think that is one of the USPs of nature-based investments.
What I really like is your association of, your values, the UN SDGs, but equally the people who you represent, your members, want a return, in their investments. And I understand the clean tech element. There's a return. I understand those social housing. There's a return. The element about nature as infrastructure, would you say the question of return is clear? And if it's slightly unclear, is that has been a contributor to why there's been in some ways a market failure in terms of corporates and asset managers to really look at nature as an investable asset class? I'd love to get your insights on that, Leandros.
That's a big set of questions there, Walid. I'll try and pick some of those up. The strategic asset allocation question predominates as a first point of call. And just, for some listeners out there, the way that works is that you have the employer and the employee contributions that go into the pension. Every 3 years, you reset the asset and liability ratio, the funding ratio. That creates a required set of returns, which then have to be codified in a neutral strategic asset allocation benchmark. So you're right, there is an expected return that's needed to pay the liabilities on time and when they're due. One of the things I always say from a CIO perspective is that not every single investment has to pay that expected return, right? Equities in general over the long run will take up more expected return than bonds, for example. That's normal and understood by all. We then tend to, when it comes to emerging asset classes, which nature could be considered one of them, to put a very, very high bar on that. And then we become very conservative, very nervous about those sorts of investments. And again, that from a CIO perspective is just being proportionate to think about the total fund and then making certain allocations within the fund that have higher risk. And that is absolutely normal in portfolio construction. I just think that nature has been possibly given too high a bar for certain investors. And certainly from my perspective, I gain confidence from the way I can understand the portfolio construction for the total fund in terms of making bottom-up investments in nature.
Just coming back on the portfolio element. So how do nature investments complement, or if you want, challenge those traditional classes? So we talked about bonds. And also, you said, it puts that bar quite a high level because, you've got to balance the risk and the reward because to some degree, whilst, Darran, what you're saying, it is a million-year-old technology, while still innovative, but it is one whose rewards or returns are not quite yet clear. So how do you balance this risk vs reward perspective from a portfolio construction?
Without wanting to be too highfalutin, you have to start with modern portfolio theory, 1956. It's the way that CIOs like myself work. And that's a traditional model of looking at, mean variance optimization, diversification being a key principle there. But one of the principles underlying modern portfolio theory is that you can't change systematic risk. And that's something that natural capital is provocative to. Because if, as a society, if as economies, we have consumed too much of nature, then we are actually acting upon that systematic risk. And therefore, modern portfolio theory is not enough to actually be used as the single tool in which to set up our strategic asset allocation. Effectively, that is what I told our investment committee last year. And in setting up our alternatives program, I was making the observation that whilst most of our current portfolio construction could be looked at in traditional ways, that we had to have some bottom-up element to our portfolio construction, because if there were elements that we could act upon that could actually affect systematic risk in a positive way, then that's something that we needed to do as a pension fund.
You say that was within your investment committee. So when you presented that argument, how was it received?
Well, it's received very well by our investment committee, which has pretty strong beliefs around, the environmental side of it, within the investment in the UK side of it, and within the growth side of it. So in terms of the things that Darran was touching upon, economic growth, sustainable cities, environmental solutions, this idea of creating a new mandate, much more broad and ambitious, dare I say it, than what had preceded it, was met with open arms. Of course, investment committees are also tasked with overseeing that fiduciary duty, and it's my job to explain why it is still very consistent with our fiduciary duty to do new things within the balance of a 20 billion fund.
And could you perhaps share with us from that fiduciary duty, how did you explain it? Because I'm wondering if there are CIOs listening to this podcast right now who perhaps do not have such a receptive investment committee as you have. What top tips would you give them to be able to overcome potential challenges that they could have?
Well, one advantage that I have that other CIOs may not is I did and do have a welcoming investment committee when it comes to those investment beliefs. So in that sense, there's an alignment between what I'm trying to propose and a natural instinct to listen. In terms of the mathematics of the fiduciary duty, and I would encourage fellow CIOs to look beyond the traditional literature of which I grew up in. I consider myself a traditional CIO. The last thing I want to be considered is a reckless CIO. But I can recognize that there is a disconnect between economics and the real economy and the way in which financial returns and portfolio construction are set up. That has always been the case, by the way. There is always a disconnect between the real economy and financial returns. The question is, can we, as asset owners, do anything about that? And when I looked further and thought more deeply about what are the things that pension funds can do to act upon the failures that we've seen, whether they're market failures, government policy failures, or other things, I built my own narrative to actually make me feel that I could explain that quite confidently. And the last thing I would say, and it's not a top tip because any CIO will know this, is simply to acknowledge to themselves categorically and clearly that when you have an actuarial or required rate of return, the idea that all assets have to meet it is simply not the case. Because if that was the case, everyone would just simply always be invested in the highest return asset class. And the point is, risk-adjusted returns is part of the fiduciary and the CIO's role to explain.
And just coming back to this point about, the role that pensions funds can play in during these kind of market corrections, is it controversial for me to say, is it the job of the pension funds to do that? Is it the government's job? How did you guys put yourself in that situation to try and do those corrections?
Yeah, that's a multifaceted question.
I have a feeling I'm going to be asking you too many of these.
I'll answer it in this way. When it comes to the question of fossil fuels, for example, there is a live and very appropriate debate as to how much can pension funds do themselves and how much do governments need to implement policies that sort of recalibrate the supply and demand balance, let's say, for fossil fuels.
Yeah.
That's a fair debate and an appropriate debate to have within the asset owner, the government community. When it comes to the sort of thing that Rebalance Earth, when it came to us to talk about, that's something where I think I was able to feel that that's something I could actually do in a positive way that didn't require me to second guess how government was going to think about that. So that's sort of a simple way I would explain that particular distinction.
Thank you. And let's talk a little bit more about the barriers. So we touched upon it, with the advice you would give to CIOs, but what would you say, just zooming out, what are some of the main obstacles for pension funds in HA investments, and how did you overcome them? Is it just, we touch upon the investment committee being receptive as being a key factor, but what else is there that we haven't yet mentioned? Yeah.
I mentioned that we have the distinction of being a very large in-house manager of assets, which means that over decades we have built an investment culture that understands how to analyze, due diligence, individual stocks and bonds in public markets. That muscle memory, that knowledge creates at least the possibility to think about doing the same thing in unlisted assets and in private markets. So that's the first thing. We had some preconditions for success, let's say, to your question. But then we actually have to go and be brave and actually look at actually how we're going to do that. And if you're going to do something in venture, it's often the highest risk asset class to do. But I feel that we're a sophisticated enough organization to be brave. And I certainly encouraged Darran and the team in this instance to be as brave as possible. And the way that I got comfortable in that myself is that I had a front row seat 15 years ago with the largest UK occupational pension scheme, USS, that was going through its own journey in private markets. Initially a fund-of-fund type of investor, moving into funds, then becoming a co-invest, and then becoming a direct investor. And I always use the analogy of sort of 3, 4, or 5G for Africa. When technology has been understood and learned, you can leap forward. And I just wanted West Yorkshire Pension Fund to feel confident and my investment team to feel confident that we could move forward. There was clearly a lot of learning to do in terms of how we would actually get comfortable to present an investment idea that we could approve. But that was effectively the sequence of events that led to that.
So I'm just going to switch now to Darran, and I'd like to get your personal opinion on this. So Darran Leandros comes to you and says, I want you to be brave. I want you to leapfrog. What was your reaction to these kind of statements?
Bring it on. Absolutely, I agree completely with what Leandros says. So, we have a bit of a background in nature-based markets. If you class renewable energy as sort of like an ecosystem service that nature provides, we've got that track record of 10 years of more than 10 years of investing in technology that's going to help us achieve net zero. So we've already got that background, and we also invested in some listed forestry with both lessons learned and some success. So we've got some existing knowledge of those markets, but we had to develop that over the course of the year. But the biggest thing was I've got an equity background. Most of the team have got an equity background. Now, in most recent times, we haven't had many IPOs where new companies list on the London Stock Exchange. But going back to 2010, when I was there in the UK team, we would look at 10, 20 a year. So we're used to new companies, assessing new managers, new strategies, and accepting that equity risk that is involved. So that muscle memory, as Leandros just put it, was already in there. And we've got a large team, so I could talk to one of our investment professionals who looks at the water sector. I could draw on some of the expertise there. We've got investments with supermarkets who are prone to flooding. We've got investments in infrastructure that have similar properties to maybe how nature-based solutions will structure in the future. So you can build on that, and you've got this great network to build knowledge and confidence that we can carry out this transaction. But also, timing is everything, and there are many great ideas, but they're just at the wrong time. You came to us when I'd worked on developing this alternative proposition. Leandros had joined us. Ewan, our managing director, joined us before, and they are both very supportive of us looking at more innovative ways of working, more innovative investments, and taking more risk and accepting that along the way.
But that puts you, I would argue, maybe into the space that traditional venture capitalists have, where they think, if we're lucky in years, probably most likely in quarters, but you have this more patient capital approach to things. And I'd like to perhaps spend a bit of time on that, on, what role and responsibility perhaps pension funds have to deploy direct and patient capital. What does it mean? And is there an importance in all that for being a leader or a first mover in this space? I'd love to get your insights on that.
So in terms of what I meant by direct and patient capital, when I said it, I think as part of the press release, the direct side is the thing that Darran has just said there. If we have decades of investing in public markets and the investment universe is somewhat morphing into private markets, then we owe it to ourselves to leverage all the knowledge that we built over decades and to take the courage to actually retool ourselves for the investment universe as it exists today. And in that sense, that's the responsibility I feel as an asset owner, to move us in that direct direction. In terms of patience, we, as I mentioned at the beginning, we are a funded public sector pension scheme with no specific liquidity pressures, with no redemption pressures, with a very, very long-term investment horizon. Our strategic asset allocations are set with 20-year investment horizons. So when I talk about patience, I mean it. That is how we're set up. So that combination of leveraging our existing investment culture and leveraging our long-term investment horizon simply means that I do feel that there is an onus on asset owners like ourselves to back emerging companies who are trying to do good in the sort of spaces that we are linked to with respect to our investment beliefs.
What I love about the patient's capital aspect of it is that nature does not act within a couple of days or in a quarter. Nature, you have to be patient with it too. You've got to give it the time to be able to recover. Like, for example, when we saw during this COVID era, where suddenly we had animals coming out, in some of our towns across the UK. And do you look at patient capital also from that perspective, is how it aligns itself in terms of a timescale with nature?
Yes, in the very broadest sense. I think that, Darran talked about infrastructure as a sort of related assets of sorts. And clearly, from Rebalance Earth's perspective and other natural capital investors, we're looking at nature as infrastructure. But there is nothing unusual about sort of offtake agreements for 20, 30, 35 years. The difference, and it is a difference, is that within traditional infrastructure, we're talking about operational assets, effectively, contractual income streams that are kind of well observed and well known. Whereas in nature, Rebalance Earth and others are looking to structure new types of contracts, but the principles are the same. So in that sense, patient capital is very normal to us because we invest in lots of assets with very long-term contractual cash flows and other things related. What's different here is that we just haven't had the observability because effectively we have consumed nature and not maintained it. And so in that sense, it feels different But in fact, in the way that actually this will work, it will work in similar principles to things that we've, done for many years.
And that's what I love about, it's something you said you've done for many years, because if you look at it just from an infrastructure standpoint, pension funds have invested in traditional infrastructure, whether it's motorways, whether it is power substations, and so on. So associating nature to that kind of infrastructure, I think, is very powerful, because there's an understanding that to build these projects will take time. And until the cash flows comes in, that will also... have you used an analogy out of curiosity in terms of you comparing nature's infrastructure to traditional infrastructure and why the two have some similarities?
In terms of the fact that ultimately we're not a charity, yes. So when we ultimately make an investment, and this particular investment, which is in the venture space, we clearly have to try and understand where the financial returns do come from.
Yeah.
So even though they don't have to be the same returns as our expected returns, we're doing things with a financial return. So in that sense, yes, I have made that connection, but it is multifaceted, because we are also talking about venture.
Yeah.
And venture actually has different distributions to traditional asset classes. People talk about venture as a power law asset class where, most companies actually don't in venture succeed, and only a few do. And that's possibly the more complex area from a portfolio construction perspective to think about in terms of, our investment in nature. But again, I put that into the bigger perspective of our overall way of looking at our risk and returns.
Yeah.
And as infrastructure, during our due diligence phase, I did compare grey infrastructure, if you like, to green infrastructure. And in the round, we found that green infrastructure outperformed grey infrastructure on a cost basis. It's more cost effective, but also in terms of outcomes. What was evident was these tended to be small schemes. So what it really needs to become, nature as infrastructure, nature positive infrastructure, whatever we want to call it, it needs to be scalable. You've seen pension funds consolidating, DC funds are consolidating, wealth managers are consolidating. They need to be scalable for investors to put their money into.
And building on that, did that play a role in terms of how you are viewing nature investments from WYPF strategy, which is we can help scale these projects, but also ultimately this industry. Do you have a view on how that played?
If we put it back to our broader strategy and to why we were thinking about nature-based investments, as we've talked about, we need to make a good financial return for a measured approach to risk. So that's given for any investment that we look at. That's the bread and butter. We're also a long-term investor. We're an open scheme. So we've got pensioners who are drawing on their pensions today. So we need a liquid portfolio of equities that provide income for our liabilities today, but we've also got joiners today who will be paying out pensions in 50 years' time.
Exactly.
So we also have to have a portfolio for them, and that enables us to invest in illiquid assets like nature-based solutions for the appropriate amount of size. Now, if we had an existing portfolio that was already 50% invested in illiquids, it would be a very different conversation, but we're quite fortunate that we've got a moderate portfolio of illiquids as things stand. So that gives us the ability to invest in nature. We also want a diversified portfolio. That is key to our returns, our risk-adjusted returns going forward. So even though we've got that big, powerful equities portfolio that drives our returns, it's like the engine room of our portfolio. We also have a lot of bonds. We like to have some assets that are truly uncorrelated to equities, because occasionally you get a 2008 or a 2022 and we don't want to lose 50% of our portfolio or thereabouts. I'm exaggerating for the point, but it's hard to find truly uncorrelated assets we've looked at infrastructure, we've looked at property, we've looked at private equity, but correlation creeps in. And actually, when you find in a downturn, the only thing that goes up is correlation between asset classes. To find true diversifiers, such as nature-based solutions, like a peatland restoration project in Scotland doesn't care what NVIDIA's doing,
Indeed.
So, that's another great thing about nature-based solutions. And I don't know, I'm going a little bit off the point here, but just bring it back to how we talked about the broader strategy for West Yorkshire Pension Fund. And we've got these sustainability beliefs. So you come to me and say, I've read your investment strategy statement. You invest in illiquids, you invest in uncorrelated assets, and you want to invest for a sustainable future. Will you invest in this project? And I'll go, well, sorry, I'm an equity manager. I'm not an equity manager, but if I was, I might say that, sorry, they're bonds. So we've got these asset allocations to equities. We've got bonds. You're not a listed company. You're not a bond. Okay, I'll go to the private markets team. Okay, so they're invested in US private equity, global buyout funds. They're invested in infrastructure. You might be interested in that. They're invested in property, but they're all benchmarked against global indices. So even the infrastructure manager, they are benchmarked against a global infrastructure index, which won't include any nature-based solutions. It might be the future, but their whole outlook is benchmark driven. So that was really what is so important about what we've set up. And I encourage any asset allocation committees, any investment committees to think about setting up an allocation, 5% of fund. So it's small, but it's £1 billion. It's large as well. It's small and large. And we are benchmarking that against cash plus 2%. So it's not benchmarked against indices or companies. And that enables us to invest across public and private markets into asset classes that might slip between the cracks. So affordable housing, where does that? It doesn't quite fit into property because it's not part of the benchmark. Well, what about venture capital? Well, venture capital UK is not going to form part of private equity. What about SME financing, which is so important? Again, no one's going to look at it. What about local opportunities? They're not in the benchmark. We need to look at them still. We need to invest in them. And what about nature-based solutions? And that's the final missing piece of the jigsaw, I think, to enable pension funds like ourselves to invest in nature-based solutions.
And thank you for detailing that, because I think it makes it very clear on why some funds who may, I guess, on a personal or individual level would want to make an investment, but just the setup is not enabled to do that, where you don't have the right indices or you don't have, the comparison metrics. So thank you. That actually shed a lot.
That's the strategic asset allocation that Leandros was done. That is what most pension funds use. Now, there is another approach called total portfolio approach, but that is probably for perhaps another podcast altogether. But that, more pension funds are looking at that, particularly sovereign wealth fund, Canadians and Australians and New Zealand. And we do incorporate elements of that approach in terms of we talk together as a team and we talk about investments as a team. But that would really game change certain investments like nature-based solutions, because they're competing for capital against everything else. But we're not there yet. So perhaps that's for another discussion another time.
So you've invested in rebalancers, and thank you very much for that. But if other initiatives, whether they're limited companies, even maybe whether it is a city or an NGO that comes to WYPF or another fund that has a similar strategic allocation, would they be able to come basically asking for capital to invest in a project? What top tips would you give to both the organization and to the receiving pension fund to facilitate that conversation? Because it seems that there are lots of projects out there in the UK, but because of their mindset or limitations, they usually think in projects of sub 3 million or sub 5 million, for example, which of course doesn't quite work in or for you. So there's a scale issue. How do you manage this disconnect between projects who can't think big because they don't know where they could get that capital, and to pension schemes who want to make a difference, who want to make a strategic allocation in this space, but can't find projects of a right size? How would you go and I guess resolve this disconnect? I'd love to get your insights.
Well, that is possibly one of the downsides of pools being or funds being bigger, of DC being bigger, wealth managers being bigger, because there is then a danger that you could miss out on those micro companies, those smaller companies, and these projects that are below size. There is that risk there. It doesn't have to be that way, because you should be able to build up a team that's got enough strength in depth to be able to still access those opportunities. But specifically to you're asking, I guess we need to do more from our side to communicate what exactly we want out of a project, what size it is, and if it is below that minimum requirement, it involves collaboration, doesn't it, across and a more landscape-based approach, to make it more investable for pension funds.
Yeah, maybe just to add to that, you have to start somewhere.
Yeah.
And especially in an emerging asset class, it's going to be small by definition. And so we have to have the bravery, the governance, all the things we talked about earlier, to be able to do that. But the corollary of, the danger of, becoming too consolidated and not being able, to look at local investments is that ultimately the natural capital industry wants the industry to actually be large. So even though, we have to start small for this to actually have a big impact on the UK, for example, we actually do want, eventually these projects to get bigger and bigger and so on and so forth. So I think in terms of the disconnect, it's simply acknowledging that very point. We have made a small investment in a company. It's a venture investment. It's a high risk investment, but it's directly related to something that we think needs to grow within the wider economy. And so we want to be an exemplar, to be a first mover if we have to be, because our governance structure allows us to be, and to encourage, everyone else. I think that what, Darran's point about being clear with those who come to us, that's absolutely true. But I would also encourage companies who come to us themselves to think about what is it that asset owners are good at in terms of being able to assess things. And, one of the things that's come out of the government consultation for the LGPS is that it's encouraging strongly for target investments into local projects. That's one of the key things that the government is doing right now. So even though those things might be small tickets, it just means that you need to have dedicated resources, because eventually small tickets become larger tickets, and you're creating a sort of a more scalable resource and knowledge around it. It's obviously something that the Northern Pool that we are part of are very proud of, and Greater Manchester and Merseyside have made lots of good local impacts in other areas, such as housing, for example. We're making this inroad into nature at West Yorkshire, and hoping that others see that for what it is, and join.
So less focus on the initial ticket size, which we do tend to focus on. And in some ways, that's a little bit lazy of investment managers, because you get a lot of income in as an investment manager, and it's a way of filtering, isn't it? You say, I don't want to look at anything below 10 million, job done. But actually, we shouldn't be looking at the initial ticket size. It should be the outcome, the financial outcome, and the impacts, whether it's social, economic, or environmental.
And I guess that's a bit of the trick, is because the outcome, the financial outcome, is something that we're all looking at, in defining. The social, the environmental outcome is quite clear, but I just want to come back to this financial outcome and how that relates to the local element. which, local government pension schemes is quite important to them. Too often in the environmental space, we focused on, carbon credits, biodiversity credits, and they've had their set of challenges. They're still, an industry that is, in my opinion, will grow. But too often, they've been attacked because sometimes those carbon credits are produced in faraway places. It loses the local element. Here, by making nature as infrastructure, it is looking at, if I may use the pun, rebalancing nature for it to work better at a local level. So if two cities want to improve trade, you may build, let's say, a motorway or some sort to connect them. If you want to reduce flooding or if you want to reduce drought, you will invest in nature as infrastructure to fix that landscape, to perform. But that fundamentally is a local level, so that your pensioners or your members could literally go see, a short walk potentially, or a drive or a train ride away to see where the money has gone to. The corporate who takes an offtake agreement to help finance, to provide the cash flow from a financial perspective, can have an away day with their staff and again see that component, which is why I think there's opportunity from the financial perspective is it becomes real because it is in a local space. It's good from your investment perspective because you can go and see it and your members can see it. And I just wanted to get your views on that, on not just the financial aspect, but how important is that local element, the element of it being tangible?
Yeah, the engagement's hugely important. I mean, we've seen that previously with real estate investment. People like property because they can see it and they understand it. And I think on climate and carbon, that's one of the difficulties. I mean, carbon's great, isn't it, that it's fungible. A ton of carbon is the same there as it is there. Nature gets very complicated in that biodiversity gain in West Yorkshire is very different to what it will be in the Amazon, say, and the needs and the requirements. So it's complicated. But on an engagement point of view, members can see nature loss and they don't like nature loss. And they get very engaged about that. There's a lot of climate deniers or previously climate deniers. There's not many nature loss deniers. Because they see it. It's front page news, flooding last week in the UK, flooding everywhere. Our rivers in the UK, that is also front page news, how polluted they are. So I think that's really important. And for local place-based investment, it could be huge. A lot of place-based investment happens in those big metropolitan boroughs. So it's easier for us with Leeds and Manchester and London to invest in property in those. You'll get a decent commercial return and high impact. For those other areas, more rural communities or left behind towns, they're seeing less of that place-based investment, although the impacts required is huge. But that's where nature-based solutions could maybe come in.
At a catchment level, exactly.
At a catchment level, because you've got to include that feed into the cities, but the work that's required is required in those deprived rural farming communities. And huge environmental impacts in terms of climate mitigation, biodiversity improvements, ecosystem restoration, but then also the social and economic impacts of more resilient communities, better jobs, healthier soils, healthier food, and it all feeds back to us as more long-term sustainable returns.
Yeah, I mean, Rob, as you know, Leandros has this, Rob, the CEO of Rebalance, has an expression, of investing in a world worth living in, which ties in, a little bit of what you just mentioned, Darran, but I wanted to give you, Leandros, the opportunity.
I remember when Rob, so I'm a Londoner, I'm a concrete jungle Londoner, who's moved to the north of England, and what a wonderful thing that has been, for me, my family, and also the job that I love doing. But when I first heard Rob say that, as a Londoner, as a cynical Londoner, it sounds, wishy-washy, or it doesn't sound wishy-washy coming from Rob. Yeah, I've known Rob for 15 years, and nothing he says is wishy-washy. But it's certainly, it is difficult for someone like me to take that in and make it resonant for me. But the bits that really are resonant and relevant to my head as well as the heart are the things that, that Darran has touched upon there, and just to amplify, which is that the whole world of ESG has become a highly political subject, both in society, but in the world of investing. And I was very conscious as we started to try and think about our new program, how are we going to do certain things that could appeal across the board? It's not my job to do that. I don't know the political affiliation of our 300,000 members. It's not my job to try and discern that. But there is an element in which one wants, where one can, to take this hot potato of ESG and to find something within that world that we can all agree on. And we can all agree on the things that Darran has just described. And our 300,000 members can also see that for what it is. And in that sense, I actually am very positive about that part of the government consultation that is focusing on, targeting local investments. Because, if pension funds are so strongly of the belief that effectively they're best placed to manage those funds from a local perspective, or nature-based solutions is clearly one way in which you can actually do it in action. And so the Rebalance Earth transaction, I hoped, and certainly the initial momentum seems to confirm, is that my instinct that this was something that people wouldn't just have a political view on, because it's an apolitical issue, the issue of water in the UK, is important, and it does connect us to our members, hopefully in a way that certain other things actually have more sensitivity and controversy.
Now, you touch upon the question of the heart. You also mentioned you have a young family. So I want to dig into more the personal aspect, both of you and Darran, who I know you also have a family. How much did that play a role in moving in that direction of looking at nature, of investing in nature, providing a return to your members? But how much has your personal situations as fathers played a role in driving that change?
Yeah, I'm an emotional Greek Cypriot, so I may tear up in answering this question. The most straightforward answer to that question is that I take my job incredibly seriously, and that has to be done from the head, and as a primary driver. And I learned from the best. My mentor was Roger Gray, who was the CIO of USS, the largest pension plan, for 10 years. And it's without him, I wouldn't have the role that I currently have. And so what I get a little bit emotional at is that I have also had to grow up. And, even though I'm a traditional CIO, have learned from the best, I may have also had to form my own additional investment beliefs that may not align with Roger Gray's or someone that I'd learned from many years. I'm not saying Roger would not invest in nature-based solutions, far from it, but I am saying that structured approach, which has to then allow for, different things, to be done, I had to internalize that for myself. And I think that's where the heart played a part in giving me that additional courage. I joked about being a concrete, jungle Londoner, but when you live as I do in Ilkley, in West Yorkshire, beautiful part of the world, near the moors, my oldest is nursery. It's not a forest school, but it might as well be in terms of the space that it's around. And then I know with my head the depletion of biodiversity. The facts speak for themselves. I would say the heart came into it to simply encourage, my head to allow for that new way of thinking and bringing that into the asset allocation framework, to the specific benchmarks that we set for the new alternatives mandate that Darran touched upon, to try and make sure that where the heart could play a part was so that then when the activities are being done, they're being done in a sort of coherent and structured way, which is the first priority, but where they can then allow for, ultimately the generations that succeed, my own children, something that we've done today might play a part in that.
Brilliant. Thank you, Leandros. Darran.
You didn't cry. Well done.
I didn't. No. Really.
Even pinching his life.
My head was on. Yeah.
I mean, similar. I get quite awkward and nervous talking about personal matters in a business setting. So maybe down the pub we can talk a bit more. And very much the job is a professional job, and we wouldn't have it any other way. I don't think you don't need to have children to care about the planet. We see, our younger members are more who don't have children care far more about the planet and the issues. I mean, they've got longer to live, I know, than about me and Leandros, but I don't think it's a prerequisite. But it does make you think, obviously. And I have personal pride in what we're doing, not just because it's a nature-based investment, but also the innovation that we've brought about, the leadership that we've shown, and the collaboration we're carrying out with others. I think that is key going forward, by the way. On a personal level, you mentioned Ilkley. I mean, I love going out into the countryside for walks, but in some ways, you've slightly ruined those walks, because I thought I was going out into nature because it's fresh air, it's it's fantastic views, but actually in some areas of the Yorkshire Dales, it's like an ecological desert. In reality, there's more nature in towns and cities than there is out there, and so that's sort of the shift in baseline syndrome that we're all suffering from. It didn't have to be this way, and we've got to recalibrate our brains a little bit. It's sort of green and pleasant land. It's a green land, but in some parts it's not actually that pleasant from an ecological point of view.
So you're a first mover and innovator, both individually and as a WYPF. Now let's look 10 years ahead of us. How would you have wanted the work that you've pushed and initiated? How's that work changed, and what kind of world are we looking like in 10 years from a investment perspective? How do you want pension industry to be looking at natural capital in 10 years compared to now? What is your wish list?
I'll start with one or two. Investors and large asset owners tend to be global in nature. I am myself. It's part of the strategic asset allocation setting to be global. But there are only so many things we can control from West Yorkshire in terms of global investment markets. Can West Yorkshire play a part in deepening the investment in replenishing nature within the UK? Can it play a small part in that? We hope so. But that's something we can actually make an impact on. And I think, one of my wish lists would be for, my fellow community of asset allocators, of universal asset owners, to not feel this huge tension between this sort of global fiduciary requirement and set of, beliefs in the global markets, and have that as somehow as constantly a sort of headwind towards actually doing something, within the area in which, you perhaps are actually based, or within the country in which the asset owner operates. We don't have, Darran touched upon it earlier, within our private markets program, which Darran certainly leveraged in terms of thinking about how to structure and negotiate our investment in Rebalance Earth. It's hard for our private markets program to go beyond simply due diligencing, large, infrastructural private equity managers. A lot of them are in the US, Asia, Europe, and so on. It's quite a different thing in terms of what Darran was having to do in terms of due diligence in Rebalance Earth. Yeah, right. In terms of the intimacy of that. And intimacy is awkward, right? Why we get emotional about talking about the heart. But that's the intimacy that's required. And it's awkward for me as a CIO because a CIO can sit above the fray, set the asset allocation, look clever in terms of, that setting up of the game and the benchmarks and so on, and then just sort of leave it there. But in that sense, that would be my wish list for sort of CIOs and asset allocators and the system to get their hands a little bit dirtier in terms of actually how they're going to go about investing the next set. There's something that RMD says, Ewan, who Darran referenced, which is absolutely right, which is that the amount of work that goes into a 5 million local investment is disproportionately hard to simply investing 100 million in, Apple.
Yep.
Okay. And that sets a high bar, but it's not an insurmountable one. And it can't be an insurmountable one if we're going to, create the outcomes that we're looking for. So it requires some hard work to do. It obviously requires smart and knowledgeable people and, Darran's leadership and alternatives and to recruit and retain those people. But there is for me, a very obvious alignment. It's not just our younger members. It's also our younger members of investment staff. We talked about on the way in. Investment strategy is always set with in relation to required returns. And that can be somewhat of a dry subject matter. But if we actually want to preserve genuine, direct investment of assets, we have to remember who our staff are and what they care about. And if we can't do that, then we're not going to retain our staff, and therefore we're no longer going to be the distinguishing in-house office that we love to be. So in that sense, we actually have to align ourselves also with the actual people who are doing that investment. And for me, that alignment is actually quite simple, based on all the things that we've said today.
And from your perspective, Darran, is there anything you'd like to add to that wish list?
Build on that wish list for ourselves as West Yorkshire Pension Fund, or we will become is continuing that recruitment of those young stars, if you like. They're incredible, like from our graduates to our analysts to our deputies, all incredible hard-working staff who just get it, if you know what I mean. They just get it. And so, keep them, build on that team over the next 10 years and build that centre of excellence in the north of England, which is required. In terms of natural capital, I sincerely hope it's before then that it's an investable asset class of its own right. I think it will be. I think there's so many, all the conferences we go, it's the top billing. It's where asset allocators are most likely to invest over the next few years. But I'd go actually beyond that because, if funds start allocating 2% to nature or 5% to nature, you've still got your 95% of portfolio. So it needs to go beyond that for either every asset class to consider nature, or to be in listed markets, to be in bond markets, to be in private markets, but also at a company level. And companies will be assessing their financial risk when TNFD comes in. It might form parts of accounts going forward, and then that's when we'll really see that drive for change.
And actually, I will just add to that because it's such a critical part. Rob talks about the 2% to protect the 98%, and that's a very neat strapline for what I was spending too long talking about, which is modern portfolio theory and why it needs to be somewhat subverted. But it's very important because what Darran said is true, that ultimately everything does need to be integrated across the total fund. But it's not realistic today to expect that. And if in fact you do expect that integration to take place, you're creating a false expectation, which actually is never going to be met. So when I look at the world of ESG, and I used to work in a commercial asset manager before West Yorkshire, the drive towards integrating everything, within your investment thesis was a strong ambition, but it was very hard to meet. And therefore, actually, that can become actually quite demoralizing from an investment perspective, because it becomes a checklist item,
Right.
rather than actually a true part of your investment. And so the only thing I would add to what Darran has said is that I had to think about that quite consciously, even in making this investment, that in the sense, that for now and for a period of time, we may have to look at this asset class, in and of itself, unintegrated from the rest of the portfolio, more bottom up. But that's okay, because we're going to learn a tremendous amount about how best to do this and help the rest of the system. And I'm saying this only because that is an additional thing, coming back to something I said earlier, which CIOs quite rightly might worry about, which is having a set of investments that are sort of somewhat unanchored and disintegrated is difficult. It is difficult for me. I'm an ordered guy. I like structure and organization. I like to understand everything that's going on, and to actually have a little place here where some of that, not all of it, is being done in a way that is very bottom up, very organic in that sense, is actually difficult from my perspective, not from Darran's, because Darran's actually doing it at the portfolio level and thinking about it. But it is quite hard from an asset allocation perspective to look at that. But I think actually at this stage, it's a more honest way of actually starting the journey that I know you guys are most passionate about.
Definitely. And the second to last question is, if some of our listeners or members of different pension schemes, or are young graduates who are starting in local government pension scheme or any pension funds, what advice would you give them to, let's say, mimic the journey that West Yorkshire Pension Fund has had for their own pension, as both an employer, as a graduate, as an employee of that company, but also as a member where they draw, a pension from? What advice would you give them to have a chat with their pension fund?
Make sure they have a pension. First and foremost, many graduates, when I graduated, waited too long to have a pension, and they're regretting that now. So get a pension as early as you can and that would be Rob's advice, obviously, as well, to get those compounded earnings over time. And to engage. Engagement with us, I think, is a little bit easier because we've got a website, we produce our holdings, we've got reports and accounts, we send out newsletters. You can go to our AGM if you're a member. But I know for some in private sector DC schemes, it's incredibly difficult to find out who your pension, or it seems incredibly difficult. But actually, there's a phone number or there's an email address, and get in touch and find out what your pension is invested in. And if you don't like it, tell them about it.
I may add a couple of things just in terms of investment people maybe joining pension funds as graduates. The first thing I'd advise is be engaged with the total end-to-end of how pension funds are actually run. So it's very easy when you come into a pension fund to just get focused on your area of activity, what you've been given. But actually, if you truly understand the end-to-end that starts with everything that we were speaking about earlier, you can actually see how your work impacts that, but how you can also impact the actual way in which the pension fund is run. So I get inspiration myself, and I've got inspiration myself from seeing our young, bright things in terms of what they're doing. But it requires that sort of level of engagement with the rules. So even though I've given some sense in which we've broken the rules a little bit in terms of how we set them up, it's only because I understand the rules very well. And young people need to do the same in terms of understanding the end-to-end. The second thing I would say, and I think most bright young things already do this, but I would simply reinforce it, is that those who've studied economics over the last 30 years have done it in the very neoclassical fashion. And when it comes to issues of climate and other related areas, I'd encourage young graduates to sort of maintain that courage to keep asking questions about the economics they've learned. And the way that I would phrase that from an investment perspective is that while there has always been and will continue to be a difference between real economy and financial returns, one of the purposes here is to make that disconnect smaller.
Yeah.
But you, again, can only do it either if you understand the rules of the game in terms of how pension funds are governed, but also if you understand what the previous rules of the game were in terms of understanding the relationship between economics, the real economy, and finance.
And for my final question to the both of you, if I could invite one or two guests of your choice, who would you like to be in the golden chair?
So just building on that, Leandros talked about economic theory. Kate Rayworth would be fantastic. She wrote the Donut Economics book. So she would be fantastic to talk about economic theory if we want to go down that route. She highlighted the fact that the economic machine that we've built that works in terms of consumption and income, that machine works and it was showed to work, but it was plugged into something. It required energy and we're running out of that energy. And it was also devised by men who relied on their mothers to feed them and support them. So there's an inequality issue there as well. Now, I haven't met him for a few weeks now, but I could have a word with the king. He's quite busy, but he's got quite a lot of land and he's obviously a huge advocate of nature. He was talking about nature before it was trendy. Other than that, bring in some youngsters. I've met some of your team. They're amazing people. Talk to them about what they think about nature. I think that would be quite interesting as well. Neil, who you've recruited, the guy on rivers. Sorry, I've mentioned a few now, but
You're on the roll here.
Yeah. I'm just thinking out loud now. I mean, what that guy doesn't know about rivers.
Neil Entwistle, yes.
Yeah, Neil Entwistle, I should add. So there's a few for you to go on.
Excellent. Thank you, Darran. How about yourself, Leandro?
Well, I think we've covered a handful there. So I may just give one. Dr. Steve Keen is an economist who's written a lot about climate, sort of climate science and how that feeds into modeling. And I think that's relevant because whereas I've talked about the fact that within the world of fossil fuels, there is quite a lot of disagreement and controversy about the impacts and who's to blame. I think there's less of that in nature. But I think the work that Steve Keen has done in terms of discussing that within the climate science and the economic modeling could actually be useful to actually get his ideas on how some of that work he's done there could actually be useful in terms of talking about nature.
Brilliant. Well, it's been wonderful having you both on this podcast. I want to thank you again for all of your support that you've given us and for sharing your insights with our audience. And I look forward to continuing the conversation with you. Thank you so much.
Thank you.
Thank you,
Walid. Appreciate it.